This is Iberian Property Insights, an initiative aimed for those who want to be updated on the Iberian real estate sector. My name is Alexander Lima. Today my special guest is Christopher Mertlitz, Managing Director and Head of European Investments at WP Carey. Christopher, welcome. I think WP Carey is a very well-known REIT. Still, my first question will allow you to explain a little bit about your activity and what you do.
Thank you so much, Alexander. Thank you so much for having me. It's a pleasure to join you on your podcast. And yeah, thank you for allowing me to briefly talk about WP Carey as a business and what we do and what makes us special in many ways. So WP Carey in its essence is a real estate investment trust, and that encapsulates already a lot of what we do. We invest in real estate and people trust us, and hopefully they put their trust in us in the right places, that we make the correct long-term investment decisions on behalf of our shareholders. And what really are we looking for in our investments? Fundamentally, there are a couple of key criteria that we like to see. One is that they are long-term investments. So we are classic holder, asset aggregator, and holder of real estate. Second of all, the properties that we want to acquire, we would want them to have certain characteristics. And the way we describe it is they need to be mission critical. Essentially what that means is that the property that we purchase as part of a sale and leaseback, which is the primary form of how we acquire properties, has some characteristics that make it very important for the tenant that uses the building. Why does that matter to us? Well, we want to make sure that our buildings are important for our tenants. So more likely than not, these tenants will stay in these properties for many years to come and will need those properties, and means hopefully we will keep receiving our rent payments for these properties. It's as simple as that. And so we talked briefly about the characteristic criticality. We briefly talked about this long-term approach that we have. The other ingredient that really matters for our investments is that we purchase properties where we are comfortable with the creditworthiness of our tenants. Because let's not forget, it is the tenant that pays the rent and not the building that pays the rent. It's the tenant in the building. And so we really focus heavily on what we call credit underwriting, which essentially means the financial assessment of the likely ability of the tenant to pay the rent, not just today, not just tomorrow, but again, for many years to come. And that is at its core, actually, one of the key elements of our assessment and underwriting process. And a very large proportion of our day-to-day work and our transaction due diligence work is based around assessing the creditworthiness of our tenants. So to summarize briefly, what we look for is we want creditworthy tenants based upon our assessment. We want to make sure that we buy real estate that is mission critical or very important for those tenants. And we want to buy properties where we can achieve long-term stable income. That's essentially, in a nutshell, what we do and what WP Carey has been doing for the past 50 years. And again, going even back a little bit more in terms of the history of the business, we were founded back in 1973 by a gentleman called William Pork Carey. That's where the name comes from. And he was a pioneer of this concept of the sale and leaseback, which is a form of capital raising for businesses. It's one of the many tools in the tool chest of businesses for how they may raise capital. And that pioneering concept that he came up with has really now been taken throughout the world. And we as a business nowadays, we invest predominantly in North America and in Europe. We're investors in 25 countries. We're listed on the New York Stock Exchange. As I said at the very beginning, we are by corporate structure, we are a REIT. And maybe one other main element to point out about how we invest is that we close all of our investments on a fully all equity, all cash basis. So I'll stop there, but that's in a nutshell what we are. Sale and leaseback specialist, long-term investment, big global player.
Yeah, a lot of interesting points to pick up upon. And it's very interesting, the approach of the client and the writing, because actually many investors are now also approaching, for example, sustainability, also based on what their tenants are running, their operations. If the tenant is not sustainable, then it's almost like the building is not also sustainable, stuff like that. It's a very interesting progress in the sector. But Christopher, before that, I would like to go into repricing. If last year repricing seemed to be further ahead in the US, in 2024, Europe seems to have followed the track, although with less corrections in magnitude. Given that WP Carey is a North American investor with exposure to both markets, how do you see the two continents comparing with each other? Are they still on different timings?
It's a very good question. I would say, broadly speaking, and we've seen this in prior corrections or crises, if you want to call them that, where the US market tends to react quicker. And certainly also that permeates throughout the whole economy, not just in the real estate world, but the broader economy at large, and also the responsiveness and speed also all the way up to governments at the central bank level. And we have certainly seen in prior years and prior instances that the US has been faster to adapt. I'd say broadly, probably that is still true. I know that we've seen some divergence of general central bank policy. And we know that, for instance, that on the European side, it seems like now that we're past the peak of the current rate cycle, and certainly the respective central banks are on a rate lowering a rate cutting trajectory more so than increasing. Yes, I think it's broadly true that maybe Europe has somewhat been earlier to this than the US, and maybe now that may think that there is some degree of divergence. But I'm always a bit skeptical of how short-term trajectory differences in central bank policy, and that's really ultimately a lot of the risk that was driven based upon interest rates, but long-term interest rates, not short-term interest rates. People love to latch on and jump onto this notion that the European Central Bank, the ECB, or the Fed, or who knows, the BOJ or the BOE have cut rates by X basis points, and therefore now everything should be priced more cheaply or more expensively. I'm a bit doubtful of that. I think fundamentally, as a real estate as an investment class, the way we look at it, and I firmly believe the way it should be looked at, is a long-term investment. Real estate tends to be, certainly relative to a lot of other assets, much more illiquid, whether we like it or not. You cannot snip your finger or press a button like you can with shares and buy and sell. It's a much more long-dated investment, and it's a lot more, I guess the technical term, it's a long duration investment time, especially if you're in our niche of the market, which is sale and leasebacks, which is very long-dated income and very long-term cash flows. There's a huge degree of interest rate sensitivity, but it's much more long-dated interest rates rather than short-term rates, which really what is driven predominantly by central banks at the moment. So, long story short, yes, there is some degree of divergence between those two markets. Generally, the US tends to be faster. On the rate cutting cycle, we have seen this time around Europe being a bit early to the game. But again, I don't feel we should lose the signal within the noise of the latest changes on central banks, whether it's a 25 or 50 basis point cut here or there, especially within real estate, where it's all about long-dated borrowing, or it should be about long-dated borrowing costs, and it should be about long-term investments.
How would you suggest that we do that fine-tuning and take out the noise? Because WP Carey is basically an all-equity buyer. So what are your investment decisions based on in terms of financial metrics? What should you be looking upon? Like, is it spread? Is it an yield on cost approach? Because after all, interest rates, it seemed like it's just noise. Does it really affect you?
Again, when we say interest rates, we have to be very specific what we mean. Are we talking short term? Are we talking long term? Of course, interest rate levels affect us and affect us greatly. And I would actually say, and I believe very few people would disagree with that the space that we are in, the sale and leaseback, long-term investment space, I would actually say is the most interest rate sensitive part of the real estate industry, because it's long duration. It's a very different element if you have a value add fund, or if you have a development company or you do like speculative developments of some sorts. You have a completely different risk profile, and it really different like your returns will have a very different correlation with interest rates compared to ours, which is all about basically, you said the word already, the magic word is spread. a spread on your cost of capital. And as a REIT, we mentioned earlier already that we buy everything all equity. That is true on a property level. But then on a corporate level, how do we refinance ourselves as a business? The lion's share is really through equity. We have a very, very substantial and vast majority of our total capital stack as a business is indeed equity. But we also do issue bonds in Europe, denominated in euros, in the US in dollars. And that is another substantial part of the way how we refinance ourselves. And of course, the interest cost of these bonds matters as a component of our total cost of capital. And then we look at our total cost of capital. And again, magic word here is spreads. We want to generate adequate. And now the big question mark is, what is that? And that's kind of the secret sauce a little bit as to what you consider to be an adequate spread on your cost of capital. But in the long run, that's what you're trying to achieve. And going back to interest rates, what matters? It's long-term costs of borrowing. Is for me, a benchmark like a 10-year US Treasury or a term 10-year German bond yield is much more meaningful than current short-term borrowing rates. Because when you make a long-term investment, you should benchmark that against long-term cost of borrowing rather than short-term cost of borrowing. It's one of the most fundamental elements to keep in mind is you want to match your asset and liability durations. That's fundamentally what you're trying to do. So to cut it short, for me, interest rates, yes, they do matter, but it's the long-term interest rates and those benchmarks that are the real meaningful drivers. And that's what we calculate our cost of capital against. And that's what we try to generate a good, attractive spread relative to.
And Christopher, for example, now I do understand your point on long-term financing and interest rates and everything, but we reached a point in many owners have stressed assets that they need to sell. And so sale and leaseback operations kind of boomed. All of a sudden, we just hear about sale and leaseback. I know you like it to do a lot. With this expectancy of downward rates adjustments, do you think we will see a stabilization of these kind of transactions, coming back to more traditional models? How do you see it? Will it prevail in the future?
It's a very interesting question because I see and hear talk about sale leasebacks all the time. So it's interesting when someone tells me, "Oh, this has just now become more popular in someone's space." In my space, it's basically it's everything that we do, right? Maybe the way to put it is slightly differently. So one could argue that the sale and leaseback as a way for a company to raise capital, one may think that is strongly anti-cyclical, meaning that when the economy is doing poorly and when businesses are struggling to raise money elsewhere, they would look at a sale and leaseback as a way of doing things. And then vice versa, when the economy is booming, interest costs are very low, well, which actually in itself is already somewhat contradictory, but we can talk about that separately. But fundamentally, it's not really the case. I think I would actually stay away from this notion that there is, within the sale leaseback volumes that are being closed, there is this strong correlation, anti-correlation really, negative correlation with interest costs and also with the state of the economy. Maybe there's some mild negative correlation with it, but it's not that acute. So for instance, if I look back at 2021, 22, where we just came out of the COVID years and the economy was doing supposedly very well and interest rates were the lowest they've probably ever been, that was a record year for us in terms of deal volume. So it wasn't like that period companies did not consider sale leaseback to be attractive to them. I think it is, and again, it goes back to the point about spreads. So we as a business, we can price, given that we know our cost of equity, we can look it up daily. It's our share price and the AFFO that we generate. We can look, our bonds are publicly traded. We know exactly what our, let's say, a 10-year equivalent bond yield would be. We know exactly what those proportions are. And those are really the ingredients you need to calculate your weighted average cost of capital. I can price a deal daily, and I know what my cost of capital is and what I can price against that. So kind of going back to the point about whether all of a sudden there will be more sale leaseback activity, I think what's more meaningful at the moment, again, if I go back the last 2-3 years, we've probably not seen as much activity, even though the world in terms of cost of capital has been a lot less favorable for businesses. And you may think, wow, this must be the boom years of sale leasebacks. Well, again, what's missing here is the focus on the maturities of some of these lower cost forms of funding that were locked in a few years ago. So again, people like to think of the economy as this speedboat that changes course very quickly. It's more like a massive oil tanker. And so you start turning on your wheel, which, let's say, is interest rates. It takes a long time for the actual market to adjust and to change course. So fundamentally, the point about activity and the kind of attractiveness of sale leasebacks, I think when we look into next year in particular, what we've now seen is, yes, rates have come down a bit again, and it may make it more cheaply for companies to finance. But the maturity wall, and I think that's sort of the missing link here, is that's what's actually going to be more driving activity rather than interest level per se. So a company that would have locked in cheap cost of capital 3 years ago on a 5-year term, the last 2-3 years, they didn't see any need to maybe do anything with that because they locked in their cost of capital. But as the maturity wall is now approaching and they need to refinance, they won't be hit as hard anymore with higher step up in cost of capital because rates have now come down a bit again. But still, it's materially more expensive than it was 3-4 years ago. And so therefore, we would expect actually activity to pick up, even though rates have come down again, if that makes sense.
Yeah, it makes sense. And that oil tank that you mentioned, let me provoke you a little bit more on the short term.
Sure.
Because you said that you know your cost of capital daily. So knowing that of today, would it be the right timing in Europe to do acquisitions or to be on the divestment side?
So you're talking to me, who heads up the acquisitions team, and Hans in Europe. And Hans, I will always tell you that it's a great time to be doing acquisitions, obviously. And in a way that may sound like a joke, but in a way it's also true because, again, we know what our cost of capital is. And if we want to have a spread and we see a deal with an adequate spread over our cost of capital, and the other points that we previously talked about in terms of, is it mission critical? Do we like the credit? Do we think it's a good long-term investment? Yes, it's always interesting for us to be doing deals. And I've been now at this company for over 13 years, and there hasn't been a point in time, maybe with like 2 months in March and April 2020, when we just didn't know what's happening with the world, but frankly, no one did. But maybe exclude other than those two or 3 months, if you will, we've always been looking to buy. It's not like we're not trying to time the market. And I like this quote by Warren Buffett, I think it was him, who said, time in the market beats timing the market. May have been someone else. But I fully believe in that. And especially if you work in a business that is based upon spreads, you just need to look for those spreads. Do you find an adequate spread at this point in time? And just keep investing. Keep investing throughout the cycles. When it's up, when it's down, when it's going sideways on circles. You just want to make sure that you don't want to get Mr. Forest for the trees, if you see what I mean. Keep the bigger picture, invest long term. And if you're planning on holding an investment for 20, 30, or even 40 years, and that's really our philosophy, do you really need to be so stressed on what you read on that particular article on that particular morning when you open up the FT about one particular change in one particular industry? You got to keep the long-term focus in mind, and again, underwrite deals as such, price deals as such, and then you have the luxury of time on your side. And that is a huge good thing. That's a wonderful thing to have on your side.
Time in the market beats timing the market.
Yeah,
I think it's going to be our title of our podcast. Time in the
market beats. I wonder who said that. I don't think it was Warren Buffett, actually.
It's a very, very nice quote to navigate.
Kenneth Fisher, I just Googled it. So I don't think it was actually, so yeah, it was not Warren. But he's got some great other quotes. But anyway, we don't need to go into that at the moment.
Perfect. And Christopher, narrowing down to Iberia, how do you perceive the risk-return profile of the region compared to other places in Europe? Is it attractive? Is it not?
We like it. We like it. Spain, Iberia, Portugal. We love it. We've, in fact, Southern Europe. So I would include obviously Italy into that as well. So Italy and Spain and Portugal. that region has been one of our most active the last 2 to 3 years. In a way, I would say that there's a couple of reasons for that. One more obvious one would be that in the prior cycle, as yields compressed, as interest costs were so low, maybe those, still maybe with some memory of 08, 09, and then the Eurozone crisis, maybe still some memory of that, yields never really quite compressed all that aggressively. And so on a relative basis, now as interest costs went up again the last couple of years, it was less painful to reprice. And so these markets were quicker to adjust because it was not nearly as painful to adjust. If you compare it with Germany, if you have something, I don't know, that was priced at a 3% net yield, and now someone tells you it should be 5, going from 3 to 5 is much more painful than going from 5 to 7, because it's that absolute level in yield change has a much more meaningful relative impact in volume and value if you've been at very low rates. And that's one reason why I think these regions that are somewhat more, I don't want to call it peripheral because I don't think it is peripheral, but I'd say those markets that are somewhat less excessively priced or were excessively priced, they found it easier to adjust and easier to move to let's say the transaction activity machinery to kick in again. And that's a key contributor. But also there's a lot of businesses out there, a lot of family-owned businesses, medium-sized companies that just really realize that that's a fantastic way for them, say leaseback is a fantastic way for them to generate more liquidity. There are also markets that are sometimes less well covered by other forms of financing. So on a relative basis, it seems more attractive. So I could spend an hour on that topic alone, but fundamentally, we like Iberia. We would love to invest more in it. We are active across all commercial asset classes as long as they're mission critical, which basically means we don't buy office. But other than that, we can buy pretty much anything and anywhere. Another beautiful thing about the sale-leaseback model, not only does it allow you to be highly diversified and highly agnostic to asset class per se, but also by location. So we often get asked, oh, you invest in Iberia, does that mean you would only consider Lisbon, Madrid, and Barcelona, for instance? And I would just say, no, absolutely not. We are all over countries. We don't have to have a specific city focus or anything like that. Often it's actually quite the opposite. I much rather have a secondary, tertiary location, but I have a really committed tenant and have a really mission critical property and have a really long lease. And if you take it to the extreme, if you believe in the credit and if you believe in the criticality of the assets for that credit, so you can be highly convinced that they will never, it's not going to be never, but for a very long term, not leave those premises. Again, the actual asset class per se and the location kind of over time becomes less relevant because you have, it doesn't matter where it is as long as you keep getting that long-term income.
Yeah, so let's rank all those criteria on investment opportunities, and I'll challenge you. I'll give you 4 topics, and I want you to rank them from first to last.
Sure.
Being location, overall asset quality, lease terms, and ESG compliance. So these 4, what would come first for you?
I would say, so what were the 4 again? Say again.
I will repeat.
Lease length, I have to take number 1. Lease length is number 1 for us because you can cure a lot of problems in a transaction by lease length. If you have a building that is somewhat more secondary or location that is, let's say, somewhat, not a prime property, let's put it that way, or if you have a location that is somewhat more secondary, tertiary, you can cure that by having a very long-term lease. So you can solve a lot of problems. Now, obviously, you need the credit or the company that you're dealing with to be strong enough to keep paying the rent for that problem not to materialize. But that's where we see the biggest value add that we bring to a transaction, which is the credit underwriting. So assuming we're comfortable with the credit, then I would have to rank out of those 4 as lease length as the most important one, because it solves so many other potential problems that you might have. So I'd say credit. Then what was the other one you had? I think it's building quality.
Building quality, location, and ESG compliance.
I would probably say ESG compliance is important, but I think for me, this is more of a journey. So I would rank that probably last, and then I would rank location and building in the middle.
Okay.
Between those 2, it's kind of hard because it depends so much on the context. If you have it's really contextual of what the actual building is and what it's used for. So I would then say, maybe that's my final answer is I go first, I go lease length, then quality location, kind of same, maybe interchangeably depending on the context, and then ESG. Now, why do I say ESG last? Not because it's the least important, but here's the reason. In a sale and leaseback, you have to work with the building that you buy. It's kind of rare that you can, you obviously pick the transaction and therefore directly you also pick the real estate to buy. But very often when we work with a deal, the buildings that we acquire, they may not be at this point in time particularly ESG compliant. But does that mean that ESG is not important? No, absolutely not. But it's a journey. And what we do with our tenants is that we agree with them as part of the transaction to say, look, here's your status quo. That is the current ESG situation of the building. It has all these points maybe where it's lacking. Can we find a way together between tenant and landlord to come up with a path to make the building compliant over a certain period of time? To maybe, can we as a landlord fund CapEx? Can we maybe upgrade the building? Can we support you with some initiatives? Put solar panels on the roof, put up new cladding, insulation, new heating, new lighting, you name it, whatever it is. So I'm not ranking it last because it's not important. I'm ranking it in that out of those four at the last one because it's the one that is not the way I'd say the journey and the way you end up over the course of a lease is maybe more important than where you start from, if that makes sense.
It was a tricky question. Anything you would leave up for last, it would be challenging. So
yeah. It's obviously important. I mean, we only have one world. We got to look out for it. And we are very ESG focused as a business. But again, to do it right is very hard. It's generally very hard. And there are no easy or very few easy answers here. And I don't want to claim that, we do everything we try to do what we can, obviously, but it's a collective effort of the industry, the real estate industry, to improve and to do better. And like I said, it is a process. Is whatever kind of status you think you can achieve in a building right now, again, in a few years' time, it won't be enough. And we need to do more. And therefore, it's really, and again, I've said it now like 5 times, but I think it's the journey that matters much more and where you want to get to maybe achieve neutrality, like CO2 neutrality or whatever other metric you want to, whatever metric, once we've hit it, we should keep actually moving that goalpost and we should keep improving. So that's maybe the way I like to think of it.
Yeah, you are a very long-term thinker, so it makes sense, your point of view. And one last thing, because I think it's almost crystal clear what WP Carey looks for in an investment. But let's go a step further. And for the next 12 months, where do you see the highest potential, particularly in Iberia, in terms of asset class? You already stated that location, it can almost be anywhere, but in asset class, is there any on which you are more confident about?
We really like industrial. By industrial, I don't mean necessarily logistics. Logistics is obviously very hyped, very hot market, which also is reflected in the pricing that you get to see here. But we like manufacturing business, anything from food processing to you name it, anything that can be built, assembled, manufactured. We like that. And why? Because it's an element or it's an aspect of industry at large where we can, with high conviction, establish criticality. And I'm coming back to the underwriting point that's such an important thing in our assessment and something very few investors, when it comes to real estate, look at that as closely as we do. And again, for all kinds of reasons, but we really care about that. We really want to understand why this building is so important to you. And so that's why I'd say industrial. Industrial is where we do most of our volume, most of our activities. And that's probably going to be the most exciting for us going forward. Second of all, we like certain elements of retail as well, where it's less subject to disruption by e-commerce. We like food retail, we like DIY retail, other specialized forms of retail, where there's a very localized element to it, where it's a lot more about convenience maybe. So I'd say we are, for instance, more bullish, if you want to use that word, on smaller supermarkets and grocery compared to, for instance, some large format hypermarkets, where we have a high component of non-food items that are being sold that are somewhat more challenging to work on. So fundamentally, on the side, this will be complemented by anything, specialized. As an example transaction, we 2-3 years ago we bought a big portfolio of crematoriums in Spain, for instance. And again, it's not something that you would fit neatly into an existing asset class. It's not logistics, it's not retail, it's not anything else, but it's
alternative.
It's alternative. So I'd say those are the 3 big ones. The biggest by far, industrial, and we feel really, really good about that. And that's something we like and we understand, and we want to keep doing as much as we possibly can. And that is then supplemented by retail, selective retail, and by alternatives. That's really going to be it for me for the next 12 years and hopefully the next 120 months, not just the next 12 months.
Perfect, Christopher. I think it was a lovely discussion. I don't know if there's anything that we might have left out that you want to add, but if not, I thank you for your time and for being with us. This was Iberian Property Insights, powered by Grupo Iberian.